Welcome back to the channel and welcome back to one of the greatest, if not the greatest ass kickings of your investment lifetime that you have ever received. And hopefully the worst one you'll receive in a long time, but only time will tell. We're going to talk about what is going on today, what the news is, and what you guys need to know heading into the Fed meeting because the markets are panicking today. Should you panic? Is this the time to sell everything? Should you just cash out and take your loss or take any potential profits? We need to talk about that here in this video. So we're not going to waste any time with the intro. You guys know the deal. Get your free stocks with Webull, Moomoo, and Public down below in the description, as well as come join the trading community if you guys want to be a part of that. Link down below in the pinned comment. So getting into this video, AMC is sitting at $13.63 per share right now, down 4.62%. And believe it or not, there is a lot of other stocks that are down a lot more than AMC. So I think that is a light that can be shined on a very red day. If you're looking at the broad indexes, the Dow is actually positive today, 0.21%. S&P down 0.51%. The Nasdaq down 1.81%. The Russell 2000 down 1.65%. So we're going to talk about this more in a minute, but the markets are pricing in a lot of bad news. But if you guys are unfamiliar of why the Dow is actually positive today, the Dow is really your rush to safety. These are stocks that consumers can't live without. Most of the time they have pricing power. If inflation goes up 10%, these companies can usually raise prices about a similar amount. So that's why you're seeing a lot of strength in the Dow. It's really that panic rush to safety, buy Dow, buy the Dow stocks. We're not about that here on this channel. At least, hopefully you are not as well, because I am certainly not. S&P is your middle ground there, and they don't look nearly as bad as the Nasdaq, whereas the Nasdaq just cannot get a break. This pain has a lot to do with China for the day. You can see this headline right here. The U.S. has told allies that China is signaling its willingness to provide military assistance to Russia to support its invasion of Ukraine, according to officials familiar with American diplomatic cables on the exchange. So you're getting a lot of that talk. And if you're getting a lot of that talk, that means China might get sanctioned as well. We do a lot more business with China than we do with Russia, and that's going to hurt our economy tenfold what it will by sanctioning Russia. So for good reasons, markets are probably a little fearful today, but how much of this actual risk is priced into the markets? I think if you're looking at the broad Nasdaq, all of the risk has been priced into the markets. People talk about this could be the 2000s .com bubble. No, it's not. Those companies then had no earnings, no revenue. They were shell companies. They were dog shit companies. They were your stocks that used to be hot last year, 2 years ago, that are penny stocks today. They have no revenue, no chance of seeing a profit probably ever. And they deserve to be cheap stocks. But some stocks don't deserve the treatment that they're getting. And if the markets were fair, they wouldn't be at these prices. But they are not. So how do you profit off of that? Well, you come in and be the diamond hand hodler that you are, and you buy these stocks and you hold them for the long term. As far as AMC is concerned, AMC is a squeeze trade, but at these prices, I just made a video about the fundamental case for AMC at these levels, and it is very attractive. But besides that, the more pain that comes to the markets, the more pain that comes to AMC, that is going to be the bigger rip that we see coming at a very bad time for hedge funds as their cash piles are really starting to get depressed, especially as we head into this tightening cycle. That's going to be very important. So this move is much expected, but I do think the Fed meeting this Wednesday will actually be bullish. I think the markets are pricing in way too much fear considering the global uncertainties that are going on right now. Think about it. Over the past 2 years, Powell and the Fed, they should have raised rates long ago, a year ago probably, right? They should have been raising rates in, this second round of COVID we had because everything was fine. But they wanted to take a measured approach and be careful because they didn't want to put the economy into a recession. Now, when you're faced with times of great uncertainty, when you're literally facing a recession now, The Fed is going to have to rein in inflation. They're going to have to send that signal to markets, but they're not going to hawk down and cause a recession. The Fed, every time they raise rates aggressively, has caused a recession, and a deep one at that. So that is the last thing, in my personal opinion, the Fed is going to do. Thus, when the markets overshoot to the downside, then they're going to have to overshoot back again to the upside once those expectations really come to reality that, hey, I was wrong. Maybe I should start valuing these stocks at a better price. That's obviously coming from the market maker's perspective. So I do think the Fed is not going to be as hawkish. Like we've talked about, the Fed is really pricing in 5 back-to-back rate hikes. Some people are, saying a 6th rate hike is really being expected at this moment, and you could definitely make that case. But it looks like only 5 is being priced in for right now. Still, that is too much. And if we get 5 back-to-back rate hikes, just brace yourself, because we are going through a deep recession, and I don't think the Fed is going to do that to us. Thus, like I said, I think we'll see a bullish reaction Wednesday, but we are likely to see that uncertainty really starting to build up like we are seeing today up until Wednesday. And let me just give you guys the overview of how Wednesday is going to go. So at 2 p.m., the Fed report comes out. The summary of economic projections as well. That only comes out every 3 to 4 months, and we do get one of those this Fed meeting, as well as the dot plot for the Fed and the prepared statement. The markets are going to react off of that, and the dot plot is very important because it votes. Basically, it's a voting system for the Fed, and they put their dots on where they want interest rates to be by a certain time frame, what they think the economy will grow, what they think inflation will be, and all of the Fed members get to vote, and we get to see their vote. The markets will probably react off of that, as well as the headline just report that comes out at 2 p.m., as well as the summary of economic projections. If the economic projections come in lower and the Fed revises down on those, but at the same time they're becoming more aggressive on their dot plot, that's where you could see the markets really take a turn for the downside. And I do expect the growth projections to come down, but I really expect those interest rate projections to really come down as well. So it is a toss-up, but I think just logically speaking here, the Fed does not want to put us into a deep recession, because that hurts everybody. That hurts the broad economy, the thing that they are trying to protect, not just the markets. That hurts the broad economy. So be very mindful of what I'm saying. I'm not a fortune teller. I don't know exactly what is going to happen. I think it's more logical sense, if you've been investing for a while, that the markets have probably priced in a lot of this pain already. As far as the actual data around AMC that you need to know for the day, for the Ortex data, you are looking at, let's go ahead and refresh this, 20.73% short interest of free float, 106.76 million shares that are currently sold short. Cost to borrow max of 2.53%, and the utilization is at 100%. The days to cover is sitting at 2.62. So this has not changed all too much. It's looking pretty similar, but you are seeing a lot more borrowed shares for the day than you are seeing return shares of about 1.81 million borrowed shares, return shares of about 500,000. Yes, I know there is a bit of a delay there, but nonetheless, you are seeing a lot of borrowed shares for the day. As far as the sentiment, the option flow sentiment, the options trades that are coming through, you are seeing 11 orders totaling $470.65 thousand, positive order value of 46%. So it's pretty neutral as far as options are concerned for the day, which is actually kind of surprising. But you are seeing a lot of these $14 puts for March 18th that are coming through. This trade right here is for $1.06 million. So they are definitely artificially pushing down the price of the stock today. Lots of artificial shorting that is going on. I wouldn't be surprised if there's a lot of naked shorting that is going on as well today. Obviously, the synthetic shorting is at an all-time high right now, in my personal opinion. Besides that, the Sonko tracker data for this week, it's crazy, guys. It's crazy. If we do see a rally on Wednesday, it's going to be insane because we only have about 2,800 calls that are currently in the money, 361,000 calls that are out of the money. That's less than 1% of the total option activity that is in the money relative to out of the money. We have never seen that before. And if we do see a rally, then I think you'll see a lot of hedge funds instantly, and market makers as well, take a lot of pain, because that's just wild ratios right there. I hope you guys can understand how crazy that is. But the put side as well looks very good. The in the money puts at 126,000. The out of the money puts at 35,000. That's a lot of in the money puts. That is highlighting the amount of fear that we see right now. And the in the money puts, when the stock price goes up, they go from into the money, out of the money, and that consists of market makers having to de-hedge those put positions and buying stock as well. So potentially two large fronts of potential buying power that could come, and that's where these mega bounce theories that I have come to light. Like we have seen these 17-20% days on Thursday or Friday. It's because of the option activity, the puts that are in the money relative to puts that are out the money, and the same thing, the calls that are in the money relative to the calls that are out of the money. So hopefully that makes some sense, you guys. Looking pretty good in my personal opinion for that bounce. Now, like I was saying about the China situation, now China, if we do sanction China, which I think is really, really unlikely, then the markets look cheap right now. We would see a lot more pain to the downside, and that's really why I think we could not sanction China unless they really did something crazy, started attacking Ukraine or something. I mean, you have to do a lot to get sanctioned by us. Even Belarus is not sanctioned nearly as much as Russia. We've hardly touched them, and they have used their country to launch an attack on Ukraine. So, you are going to see a lot of fears about that, and the markets did take a big move to the downside when these reports did come out, but I really think that is not going to materialize. I don't think the markets or our economy could afford it, and that's part and part why stocks like Apple are falling so much today. Down 2.65% for a stock like Apple is kind of crazy, and that is due to they have a lot of business in China, and those potential fears of sanctioning China would hurt Apple more than most companies nonetheless. So that's really the situation behind the fear in the markets today. We do have talks that are supposed to be happening here soon between Ukraine and Russia. We'll see how that goes. We had talks about a potential ceasefire, and that could also be a very bullish thing as well. Even if it's a temporary ceasefire, the markets would love that. As far as the technical analysis is concerned, if any of these numerous positive things happen, I would expect the stock price to go back above $15 per share. If we do get that mega bounce, you could easily see a 20 to 30% positive day, given the amount of options we see on the option chain, and that could put us back in that $18.50 to $20 range. Keep in mind, that was still my price target. That's what I put out on Sunday. In between $18.50 and $21 per share is really that range that I think is going to happen. Now, is it possible we go to $10 per share if the Fed comes out and hawks us to death? If they are super hawkish, if they reiterate that they're going to have to raise rates at an aggressive pace, and it's looking like they're going to have to do a 0.5% rate hike, could we fall to 10? Sure, we could certainly fall to 10, but that means our rebound is going to be that much harder, and believe it or not, the rebound will happen in a couple day time frame. You could sit here and lose 3 or 6 months worth of gains, or just lose 3 or 6 months worth of your investment capital and then get it all back in only a couple days. So that's why I want to be fully invested in the markets, especially in AMC at this current moment. Now, as far as the MACD, it is slightly on the bearish side, but not really telltale here. It's kind of neutral when it comes down to it. As far as the RSI is concerned, that is at 33.17, so we are approaching oversold levels, and that means I think we should get a bounce. Every time we do hit oversold, besides right here, we have seen a bounce from those levels. Think about right here, guys. We were at about $22 per share. We hit oversold, barely under that line, and we went all the way up to about $32 before we did find resistance around the 100-day moving average. So, it's definitely not looking good today for the broad markets, but I think a lot of the pain has already been felt, and I think a lot of the markets pricing has already been done, especially today. So if you guys want to join the trading community, get a alert every time I make a trade, which I will be making trades around Fed Jerome Powell, then definitely come check that out. But that is going to be all for this video. That is all you guys need to know. Nothing too crazy to really add. Just to reiterate yet again, if you did not see any video I've made over the past couple of days, the max pain is also at $20 by this Friday. And if you are unaware of what the max pain means, that is the price where the most option holders lose the most amount of money. Thus, the market makers make the most amount of money, because the market makers, they hold about 90% of the back end of the obligations for calls or puts that you buy. They are the ones to sell them to you, so they want them to expire worthless in massive amounts. That $20 price, another just kind of validation to we could see a bullish rally here throughout the rest of this week. So thank you guys for watching. Hit the like button, subscribe to the channel, all of that good stuff. Get your free stocks links down below in the description for Webull, Moomoo, and Public. Definitely take advantage of that while it does last. And also, like I said, join the trading community if you guys have not already. Thank you for watching. I'll see you later on tonight on the live stream. But until then, you guys take care.